Welcome back to Mortgage Markets and More. I'm your host, Peter D'Angelo. It's been a while. How are you? How have you been? I know I took the summer off. I had quite a bit going on, but I'm excited to get back into the regular rhythm here, giving you all an update on real estate, updates on mortgages, peppering in some stuff personally that I'd like to share. I'm a musician, doing different stuff. So I'm going to share a little bit more as we continue this podcast going through to the end of the year. But there's a lot to catch up on, and I thought now is the perfect time to dive back in. And I'm not going to do so much of a data dump as I've done in the past with certain real estate reports and whatnot. And then moving forward, we're going to just be doing this every Friday. So once a week, and this way you'll be prepared going out there to shop in what I anticipate is going to be a very busy fall season and possibly busy winter season. And the reason why I think that, I'll be sharing shortly. So first and foremost, I wanted to give you an update as to the interest rate environment, what's driving interest rates, and then we'll get to the interest rate component because that's going to have a domino effect. And I'm going to be sharing some of my personal beliefs and personal opinions about the market and where things are going to be going, in my opinion, going into the fall and into the winter. Now, last time we spoke, tons of volatility, and it's been a very volatile year. And when I say volatile year, I mean there hasn't been a status quo. Interest rates have gone up and down. Housing market has gone up and down. If you've taken a look at any of the National Association of Realtors reports, that's had a wild roller coaster ride throughout the summer. It was not your typical summer market. It was still busy, but not typical. And there's a number of things that have been influencing that. And there's been some serious, tangible changes since the last time we spoke and the last time I presented some information for you to consider as you're maybe shopping for a home or just interested in real estate. We have talked in past episodes about inflation. So we're going to start with inflation because that has been the primary driver for interest rates going up. To recap, the Federal Reserve saw inflation peaking. What's the lever that they pull? They pull the lever of shooting interest rates up. And when they raise their benchmark interest rate, the Fed fund rate, that has an effect downstream for all types of lending, car loans, credit cards, home mortgages, the whole like. Since that's happened, inflation started cooling and that they've got the desired effect that was happening. But there's two components. We've talked about this before, that the Fed has what's called a dual mandate. That means they need to, one, take a look at inflation, make sure that inflation cools properly to their target of 2%. And secondly, they need to keep an eye out on the labor market. When they raise rates, it makes corporate lending more expensive. Corporate lending being more expensive could cause corporate margin, corporate profits to drop. When profits drop, that's when layoffs happen. So you can kind of follow the chain of how this can have an effect on people's jobs and whatnot. We'll start with the inflation component. Then we'll talk about the labor component, employment, and the next Fed meeting is the 17th and 18th of September. Right now, there's an expectation for a Fed rate cut. It's pretty much almost a guarantee at this point, based upon comments by the Fed themselves, based upon the data that I'll be sharing shortly, and also just the overall market expectations have already what we call priced it in. That means they are trading in a manner that expects these interest rates to drop. And when I say priced in, we're talking about that bond market, which every time I give you interest rates, I talk about the bond market because the bond market is something that affects interest rates directly. So we're going to start off with the Fed's preferred inflation gauge. That is a personal consumption expenditure. The last report's from August 30th, and it is the July assessment of personal consumption expenditure. That came in at 0.2% increase month over month and 2.6% year over year, which is actually 0.1% lower than what expectations were. We are now, and if you remember other episodes, we were in the 2.9% range. Now we're really close to that 2% target. If we look at the CPI, the Consumer Price Index, that is recent. That came out as of recording this podcast yesterday, which was September 11th. On September 11th, we got the Consumer Price Index that came in at 0.2% month over month increase and 2.5% year over year. For comparison, that's 0.4% down or 0.4 percentage points lower than it was in July. And that's the lowest level that we've seen the CPI since February of 2021. That is showing us that inflation has been making proper progress toward the 2% target. That is why there's an expectation in the market for interest rates to continue to decline, because there's an expectation that the Federal Reserve will reduce their benchmark interest rate, the Fed fund rate. Here's the stronger case for that. Let's look at unemployment. Unemployment numbers came out last week, and that was showing us what unemployment was in August of 2024, and that was at 4.2%. And if you recall other episodes, we were talking about being in the threes. If we reach that 4%, I may have even said it, if we reach that 4% level or a little bit higher, that's when the Fed's going to start paying particular attention and really feel an impetus to start bringing down their Fed fund rate, because that means there's a constraint happening in the labor market. Add insult to injury here, we, over the past couple weeks, received a Bureau of Labor and Statistics revision of what the number of job openings were. So this is non-farm. So in the U.S., they assess jobs in the labor market differently. They take a look at farm payroll, so agriculture, and then they take a look at non-farm. So these are corporate jobs. This is your run-of-the-mill job, factory, manufacturing, things like that. There was a huge revision of how many jobs were created and open from April 2023 to March 2024, and the revision was downward to the tune of 818,000 jobs. That means as we were publishing this podcast, talking about what the labor openings were and all these, the data that I would just dump on every couple episodes to talk about these reports, while we were getting it, all of that data has now been changed, which means that nearly 1 million less jobs were actually available in that 12-month period. That shows to the Fed, pair that now with the fact that we've got unemployment ticking up to over, it's 4.2. Now we're looking at a situation where the Fed knows, we've got to do something here to stabilize the economy, because job loss, low amount of job openings, that goes into recession territory. And I said recession because that's an important thing we're going to look at next, right before we dive into the mortgage rates. So we'll do the little survey of Treasury. So this is, as of recording this podcast on September 12th, the 10-year Treasury is trading right now. This is the yield in the 10-year Treasury. This is the 10-year bond. That's trading at 3.67%. The last time we published an episode, I thought this was a fun fact. The last time we published an episode that was a mortgage rate update, the 10-year yield was 4.67%. That means it's a whole percent less than it was back in May when we had our last mortgage rate update. The 5-year is now 3.45%, and the 2-year is 3.66%. This is important because we talked, and you've heard about this, was that we had something called an inverted yield curve. That means that the short end, the shorter duration bond market, that's the 2-year and the 5-year, those yields were higher than the 30-year for quite a while. I'm talking years. Recently, within the past couple weeks, that 5-year finally dropped down, and so did the 2. So the 5 and the 2, now the 2-year just 0.01% less actually than where the 10-year is, but it's still lower, and that means we don't have an inverted yield curve anymore. So everyone who said, well, every time there's a recession, it was preceded by an inverted yield curve, and people were calling for a recession 2 years ago. Now, a case could be made that we had recessions. They were just in particular sectors, different areas of the economy. But let's just take a look at this right now. It's evened out. It's not a recession right now. But now people are starting to say, oh, well, now that the yield curve is, flattening out properly, maybe that's the sign for a recession. Who's to say? We're going to have to see that. Recessions are never called when you're in it. They're always called afterward, and it gets identified that we were in a recession at that time or through that time period. Now let's get into the mortgage rates. This is actually great. I'm so excited to come back and deliver great news for you, because if you are a first-time home buyer or someone who's been on the fence about selling their home and downsizing, upsizing, here we go. Here's the meat and potatoes. The 30-year fixed rate conventional mortgage average 52-week low right now. We are in a 52-week low for the 30-year mortgage rate. This is according to Mortgage News Daily survey across different lenders, 6.11% for a 30-year mortgage. The 30-year FHA is at 5.67% on average throughout the country. The 30-year jumbo is at 6.7%, and the 15-year is at 5.62%. All of those are at their 52-week low. That means currently we have the lowest interest rates we've had in a year. That's important. The only thing that isn't as low or it's close is the adjustable rate mortgage, and that 7.6 SOFR ARM, secured overnight funding rate, is the index that drives that, not necessarily the bond market, but that secured overnight funding rate. Those adjustable rate mortgages are averaging 6.13%. That's just up a touch from the 52-week low, which was like 5.94%. So, we could say, painting with a broad stroke, it's all at a one-year low right now for mortgage rates. We've got the information. Now what do we do with it? I'm going to share just a couple opinions about where I think things are going to go. I've had a lot of conversations with families that I help and, different people trying to strategize. Like, when do I buy? When do I sell to go buy something else? Here's my opinion. And the disclaimer on this is not financial advice. It's my personal opinion, having been in mortgage lending for as long as I have been and paying attention to these markets and these factors overall. And I do not want this to translate toward, feeling a pressure that you need to do something. I'm just going to share what I think. My thoughts on this are that as interest rates are going down, I can tangibly see, as I'm doing business in the market here in North Jersey, there's a higher uptick of people who are interested in getting pre-approved or refreshing their pre-approval. People who may have gotten pre-approved a year ago or a year and a half ago, and they got totally discouraged in the market with how competitive it was with low inventory. They are coming back now and saying, let's refresh. I heard rates are low. Let's refresh. What's this going to do? Now we're going to actually go into the real estate world. Real estate values are still going up. There's some softening happening countrywide. However, I'm talking right now about where I'm sitting, and where I'm sitting is in New Jersey. This New York metro area is a little insulated from how it's going throughout the rest of the country. I do business in other states like South Carolina and Florida, and in those markets, it's more of a normal real estate market, normal. And what I mean by that is you can place a bid that may be under asking, and there's negotiation that occurs. Here in North Jersey and throughout the state mostly, and in New York, in this tri-state area, you're really not in the running if you're placing a bid under listing. So if the list price is $500,000, place a bid at $490,000, very likely. And again, generalizations here, so take with a grain of salt. But by and large, you're not in the running. You need to be bidding over ask because it's competitive, because there's low inventory still in this market, because it's highly desirable. Proximity to New York, things like that. In other states, though, you can negotiate. My point being here is as interest rates go down, the availability and the buying power of the families that are getting pre-approved is increasing. If that means it's increasing, that means they're more competitive. If they're more competitive, that means there's more competitive buyers in the market. The only variable here that we don't know about, because we don't have any history to look back to, because we are in a unique situation. This has never happened before, where we had a 10 to 15 year run of 10 years of the lowest interest rates that we've ever seen as a country, and then rebounding and interest rates shooting up. And so people who locked in, because we offer fixed rate mortgages, people who have locked in, they don't have really a reason to leave. They've got a super low interest rate. What will it take for those who need to move, who need to upsize or downsize? What will it take for them to sell? What interest rate level would that take so that then they sell and they feel comfortable moving to the next home? Because that's what's going to wind up driving inventory, particularly in the higher desirable markets, like here in North Jersey, where there's low inventory. So my hypothesis is that as interest rates go down, competition will continue to go up. And if competition continues to go up and there's not enough inventory, then you're going to see home values continue to incline. And that's something to be sensitive to. So if you are on the fence, I would encourage you to reach out or talk to your mortgage advisor about getting pre-approved or updating your pre-approval. I think now is going to be a good opportunity, particularly here in the fall, because as interest rates start coming down, the more competition that's going to happen. The thing that can help that is if inventory comes up. If the fence sitters, people who are not sure about selling, if they commit to selling, now you've got an opportunity. There may be some more inventory. I do hope that there is more inventory personally, just because there's so much pent-up demand, particularly in this North Jersey market and in the New York metro market. That being said, let's also look at the flip side. What can happen to decrease value of real estate? The number one thing historically that's always done that is foreclosures. So if we were hearing about the unemployment rate going up and we know that there wasn't as many jobs available as previously reported, that's starting to set a stage that maybe the American consumer and the American home buyer and maybe the American homeowner could be running into headwinds over the next couple months. If that does happen, if there's an uptick in foreclosures, that could have a negative impact on real estate. The only caveat to that is that's called a distressed sale. Distressed sales do get treated differently when you're doing a market analysis. But if it happens widespread, then it will have a tangible negative impact on the real estate market. I'm not sure of the likelihood of that. I think that where we're at right now, we're seeing interest rates coming down meaningfully, a low of 52 weeks, a whole year. We're at the lowest rate that we've seen in a year. That presents to me opportunity to share that this is the right time to at least get affairs in order, get everything put together so that you can be a prepared buyer in the market and informed and know what your budget is and know how competitive and sharp that you can be. That's it for me today. I know that was a lot, but I'm very excited to be back again next week. We'll start delving into a little bit more on the real estate side next week with our mortgage rate update. But I encourage you to reach out. Feel free to email, call, text, comment, like, subscribe. Let me know if there's anything that you want to particularly hear about or anything that you're hearing about that you're like, I'd like to have a gut check on this. I'd like to know, is this bogus or is this real? Reach out. I'd love to talk with you about it. But until then, have a wonderful weekend and take good care.